You know that feeling? You're working hard, saving what you can, but the goal of buying a house seems to drift further away each year. Then you see a new family in the neighborhood. Maybe they arrived just a few years ago, already unpacking boxes into a home they own. And you think, how? What's their secret? It's a real pattern, and it's not about magic or luck. It often comes down to a completely different playbook for money, and a surprising friendship with a word that makes many of us nervous: debt. For a lot of us, debt is the villain in our financial story. We're taught to fear it, avoid it, and get rid of it as fast as possible. But in many immigrant families, debt isn't a monster, it's a tool, and you judge a tool by what it builds. A loan for a flashy car that loses value? That's a bad tool. A mortgage for a home that builds equity and roots? That's one of the best tools in the shed. This shift in mindset changes everything. With that mindset, a powerful three-part strategy unfolds. First, there's the family bank. While the classic American dream emphasizes financial independence, many cultures champion financial interdependence. The down payment isn't saved by one couple agonizing over avocado toast budgets. It's pooled. Parents, siblings, even aunts and uncles might contribute to a collective fund. This turns the mountain of a 20% down payment into a manageable hill. This family bank does something genius. It makes the actual mortgage smaller and shows the bank such serious skin in the game that they're more likely to say yes. It's merging community strength with the bank's money. Second, there's a clever game of credit stacking. Many immigrants arrive with no U.S. credit history, so they might co-borrow with a relative who has a long, trustworthy record. They merge their future earning potential with someone else's proven financial past. But there's another layer. Many come for advanced degrees in fields like engineering or medicine. They take on significant student debt, seen not as a burden but as an investment in a high-earning ticket. Upon graduation, that debt, paired with a solid salary, actually signals to a mortgage lender that they are a safe bet. They seamlessly stack a home loan on top of their student loan, seeing both as strategic investments in their future. Finally, there's a level of relentless prioritization that can feel extreme from the outside. Home ownership isn't just a goal on a list, it's the primary mission. This can mean choices like multiple generations living together to save on rent, driving very modest cars for years, and redirecting every possible dollar into the housing fund. They often avoid other types of debt, not out of fear, but to keep their financial profile perfectly clean and ready for the one debt that matters: the mortgage. So, is there a hidden secret? Not really. It's a different system. It combines the power of community support with the mechanisms of modern finance. It views strategic debt as a ladder, not a hole, and it requires a focus and a willingness to make trade-offs that not everyone is prepared for. The takeaway isn't that one way is right and another is wrong. It's a reminder that the well-worn path isn't the only path. Sometimes reaching a common dream faster requires a different map, one that can teach us all a little about resourcefulness, perspective, and the true meaning of an investment. Hope this comparison would have added positively. Please like, comment, share, and subscribe. Thanks for watching.